You have $100, not 1,000, not 10,000, just 100. And most people look at that number and think that's nothing. What's the point? They spend it on food, on subscriptions they forgot about, on things that are completely gone by next week. But here's what nobody tells you, and I mean nobody, not in school, not at your job, not even in your family conversations about money, that $100 invested every single month can turn into something that genuinely changes your entire life. Not in theory, not someday, with math that has existed for centuries. Today I'm going to show you exactly what happens, with real numbers, when you invest just $100 a month. And by the end of this video, I promise you will never look at that number the same way again. Let's go. Before we get into the numbers, let me ask you something. Why don't most people invest? I've asked this question 100 times, and the answers are always the same. I don't have enough money. I'll start when I earn more. I don't understand the stock market. It feels too risky. Every single one of those answers has one thing in common. They are all based on a misunderstanding of what investing actually requires. You don't need to understand the stock market. You don't need a financial advisor. You don't need to be rich first. You need two things: time and consistency. That's it. And here's the cruel irony. The people who wait until they have enough money to start investing are the exact people who will never feel like they have enough because they never learned how money actually grows. So let's fix that right now, starting with the single most important concept in all of personal finance. The concept is called compound interest. And I know you've probably heard that word before, but stick with me because most people who have heard it still don't truly feel what it means. Here's the simplest way to understand it. When you invest money, it earns a return, maybe 8%, maybe 10% per year on average. That's completely normal for a broad market index fund historically. But here's the part people always miss. That return also earns a return. Your money makes money, and then that money makes money, and then that money makes money. It sounds almost too simple, but the effect it creates over time is nothing short of extraordinary. Albert Einstein, whether he actually said it or not, is often credited with calling compound interest the eighth wonder of the world, because those who understand it earn it, and those who don't pay it. And the truth is, you've probably been paying it your whole life through credit cards, car loans, and debt. Today, we flip that script entirely. Alright, let's talk real numbers. We're going to assume an average annual return of 10%, which is the long-term historical average of the S&P 500, the 500 largest companies in America. This is not a guarantee, but it is the standard long-term benchmark used in financial planning. You invest $100 every single month. That's it. No more, no less. Here's what happens. After 5 years, you've put in $6,000 of your own money, and your account is worth $7,744. You've earned $1,744 just from growth. Okay, not life-changing yet, but watch what happens next. After 10 years, you've put in $12,000, and your account has grown to $20,484. You've earned $8,484, almost as much as you put in yourself. Now it's starting to get interesting. After 20 years, you put in $24,000, and your account is worth $75,937, more than 3 times what you actually invested. You've earned $51,937 that came from nothing but time and patience. After 30 years, you put in $36,000, and your account is worth $226,048. You earned $190,048. Think about that for a moment. You put in $36,000 over your lifetime, and you walked away with $226,000. That extra $190,000 you didn't work for. Time did. And after 40 years, you've invested $48,000 total, and your account is worth $637,678. You earned over $589,000 from $100 a month. That is the power of compound interest. That is what nobody tells you. Here's something I want you to visualize. If you draw a graph of your total contributions over time, that's the money you personally put in. It's a straight line, slow and steady, rising by $1,200 every single year. But if you draw a line of your actual account value, it looks completely different. For the first 10 years, these two lines are close together. The growth feels small. This is the phase where most people give up because it doesn't feel like anything meaningful is happening. But somewhere around year 15 or 16, something shifts. The value line starts to bend upward, slowly at first, then faster, then dramatically. By year 30, the two lines look nothing alike. Your contributions are a flat, modest line at the bottom of the graph. Your account value is an explosive curve shooting toward the sky. This is called the exponential curve, and you only get to experience it if you stay in the game long enough. The people who quit at year 5 never see the curve. The people who say I'll start next year just push the curve back, and they will never get that time back. Because time in this equation is not replaceable. You cannot buy it. You cannot work harder to get it. You either start now or you start later, and later will always cost you more. So how do you actually do this? Let me give you 3 steps. Step 1. Open an investment account. If you're in the United States, this is called a Roth IRA or a standard brokerage account. Platforms Platforms like Fidelity, Vanguard, or Charles Schwab make this completely free and take about 15 minutes to set up. If you're outside the US, look for your country's equivalent tax-advantaged investment account. Almost every country has one. Step 1 takes 15 minutes. That's it. Step 2, choose a broad index fund. Don't try to pick individual stocks. Don't try to time the market. Don't try to be clever. Buy something like VU, that's the Vanguard S&P 500 ETF, or VITA, which covers the entire US market. These are funds that own tiny pieces of hundreds of companies at once. When the economy grows, you grow with it. One fund. That is all you need. Step 3, automate it. Set up automatic investing so that every month, on the same day, $100 moves from your bank account into your investment account and buys that fund. You don't have to think about it. You don't have to check the market. You don't have to do anything. This is called set it and forget it investing, and it is, without exaggeration, one of the most powerful financial moves any average person can make. The goal is to make investing boring, because boring, consistent investing beats exciting, emotional investing every single time. Now here's where it gets really interesting. Everything we just calculated was based on only $100 a month. But what happens as your income grows? What if in 5 years you can invest $200 a month? What if you can eventually do $500? The math doesn't just add, it multiplies. At $200 a month for 30 years at 10%, you end up with $452,000. At $500 a month for 30 years, you end up with over $1,130,000. $1 million from $500 a month from investing in boring index funds without ever picking a single stock, timing the market, or paying a financial advisor. This is not a get-rich-quick scheme. This is a get wealthy slowly, get wealthy surely, get wealthy for real strategy, and it starts with $100. The system was not designed to teach you this. School didn't teach you this. Your first job didn't teach you this. The people selling you credit cards and car loans definitely didn't teach you this, because the more you understand how money grows, the harder it becomes to take advantage of you. This channel exists to give you the information that was deliberately kept in other rooms. So here's what I want you to do before you close this video. Open a tab, look up a brokerage account, take the first step. Not tomorrow, not next month, not when you earn more. Today, because the best time to start was 10 years ago, and the second best time is right now. Subscribe, because the most expensive thing in the world is not knowing how it works.